All right, I'm back with you guys after a few days off here, traveling across the world down to the southern hemisphere, down to Australia and New Zealand. We had a good time. We had great weather, only to come back here to Utah and have today be snowing all day today. So not quite the start to the post-vacation routine that I would like to have had, but the markets didn't necessarily have a very conspicuous start either. It was very low volume, low range, very typical for the week heading into a major national election where there's right now, as of right now, no real clear winner. And we'll talk about that. And we'll talk about the setup that the market has going into that, despite the fact that this week is a pretty busy week in terms of news events that normally would be very market moving in and of themselves. The jobs report on Friday, and we got the JOLTS numbers today, as well as a lot of major Magnificent Seven even earnings announcements coming out. Google tonight after the market, and then Microsoft tomorrow, notably two of the big names. So with all that being said, we'll talk about the technical setup. We'll talk about kind of what's happened over these last 8 days or so that I was gone, and what's going on kind of beneath the surface of the markets, which is actually more telling than what's happening on the surface. So we'll break that down as well. Take a look at what's driving the markets. We got a familiar face driving the markets today, at least. It's the face that we want to continue to drive the market. So we'll look at that. And then we'll look at our trade idea, which is coming out of that very familiar space. We'll talk about how to trade that going into its own earnings announcement. So let's go ahead and get started. Today is Tuesday, October 29th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. Okay, if you're watching us here on our blog, check out some of these other things here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We actually got out of a couple here after my break today. We also put on today's trade before the market close, and you'll see it was a good thing as the stock has already moved in the after hours in the way that we actually wanted it to, which is a good sign. So we put those on there during that class at 3:30 Eastern time. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab. And then scroll down to today's Market Outlook and like that video there. Again, the more you do that, it helps get our content out to all of our followers on those platforms because of the engagements it has based on how they work. So thank you to those who do that day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast. As you can see, we are in pre-election mode. Where we just kind of go sideways with very small ranges to the point where you can see that the intermediate line has crossed below market sentiment, which is not necessarily the best thing. But again, keep in mind that we are in a very tight range. You can see some of these other instances where it has crossed below market sentiment. You've had at least bearish near-term highs and or bearish near-term lows. You had that over here as well. You had bearish near-term low followed by another one and then a bearish near-term high. Over here, you had a bearish near-term low where you crossed below, even though it was short-lived because it was followed by a bearish near-term high, and a bullish near-term high, and then a bullish near-term low. So this one does not include a bearish. In fact, it didn't even get into bearish territory, much less down to the lower reversal zone. So I wouldn't put a lot of stock into that bearish crossover. The near-term line of the past 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So including the day that I left. So this was the day that I left. And then the 2 days of that rest of that week, the 5 days of last week, and so far the 2 days this week. So of these 10 days, including the day that I left and the day today that I got back, the near-term line has been in neutral territory for all but 2 of those days. These 2. That was it. Neutral territory. So very, very neutral. Not in bullish territory, not in bearish territory, but in between both. which is very, as you can see, it's not very common for it to do that. To have, it usually is moving between bearish and bullish, bearish and bullish, bearish and bullish. It might stay in the bearish territory, it might stay in bullish territory, it might stay in bearish territory, but rarely does it stay in neutral territory. And that, like I said, 8 out of the last 10 days. Momentum line has not gone one way or the other. One little down day there the day before I left. But other than that, it stayed in the lower half of the chart for the most part, but it hasn't gone down to extremes, right? Or even into, the lower reversal zone. We're still above the moving average, but we're not in bullish levels, right? Which is that 2.5% mark. We're only 1% above the moving average. So it's not, not that bullish here. But the NASDAQ, that's a little different story. The NASDAQ, again, the intermediate line is still above market sentiment, clearly, mainly because market sentiment is actually still so low there. It had dropped much lower than it did for the S&P, and still is pretty low. Never has gotten up to the reversal zone. The momentum line did dip down to extreme lows yesterday, again, mainly because of a small range, like an extremely small range. Half the average was yesterday's range. And then today bouncing back up and back into neutral territory. The near-term line has been in bullish levels, albeit not very bullish levels, right? And again, we never did get into bearish levels there. Like when we dropped below 60, we never got below 20. We never even got below 40. And here we are, a few days later. We're still not back above 80, but again, at least we're not bearish, right? And, we don't have a new all-time high on the NASDAQ 100. But we're close, right? We're close to the new all-time high. Same thing with the SPX. We got a new all-time high the day after I left, but it hasn't been a new closing high, right? The closing high there, 58.59. We hit 58.64 on this day. So is that right? 58.59, and then here, 58.64 was the next day was the all-time closing high for the S&P, and we're off of those levels, of course. Not surprising. The Russell is also showing a little bit different pattern. It did get a bull tag, so it pulled back enough where the intermediate line did cross below market sentiment with a bearish near-term low point. So there is a little bit of some weakness there. Sorry, it's getting a little dark here. I was wondering what happened. We did get a little bit of weakness to corroborate this bearish break. But it may be short-lived, as the near-term line is already broken above the near-term, the intermediate line. Again, with all of them below, between the reversal zones. With a good strong day yesterday, it was a good bullish cross there. Almost crossed yesterday, and obviously today, even with a small, small loss. Even with a small loss, it has crossed back into the upper reversal zone. So that's a good sign. So, we didn't follow up what was a bearish near-term low with a bearish near-term high as of right now. Now, granted, again, here's the first day we got above 40 on the near-term line. It's taken us 3 days. If you count this day as the real first day, because you were barely above it there, 40.5, 44.2, if you count that as your first day. And again, the issue with both of these days, either one of them being day one, the momentum line was below the near-term line both of those days. So, again, not necessarily setting up the best pattern for a bullish near-term peak. But as of right now, we have one. I mean, it's only at 84. It hasn't really broken strongly up above 90. But at least it's above 80, and it's above the intermediate line. The momentum line did jump above the near-term line yesterday, at least, before falling back down. So we'll see how long that bullish crossover lasts heading into, again, the election next week. And the jobs number this week, which has been a lot more market moving than the inflation report has been. Here's your Dow Jones Industrial Average. You can see the bearish crossover on the intermediate line falling below market sentiment. Somewhat of a bearish near-term line to corroborate that. This would be day one of the near-term line crossing up above 40, going from a bearish low to potentially a bullish high, so we can turn this around. You're still below the near-term line on the intermediate line, and the momentum line is not above the near-term line today. So not the best conditions. You got a bull tag. We're still below the high of that bull tag day. So again, not the best conditions yet. for a bullish move here on the Dow Jones Ether. Let's take a look at some of these other charts. Let's go to the weekly chart for the S&P. You can see we've been converging, right? We're below. We talked about this, how you tend to get like one last hurrah before things turn bearish. You tend to get one last hurrah up above. I mean, after you get the peak, you get kind of these little hurrah, these little late moves above the average before it falters. And so, obviously we had a transition candle last week at the lower high point. We're somewhat in a transition candle again this week. We'll see how that plays out again with a lot of earnings and the jobs number out. Even though we have this big event next week, you do have a lot of market moving factors today, as we've seen in the last couple of days, with earnings really moving some individual names. We'll see how that impacts the market as a whole. Looking at some of these other oscillators, let's look at the 3 green arrow chart. And you can see, obviously, we're in convergence mode. We don't have 3 green arrows in the S&P, mainly because the MACD is red. The Dow is red too. In fact, we have 3 red arrows on the Dow, hence the bull tag. Remember, we got the bull tag on the Russell too, though at least it's out of pink shading. You had pink shading there for 3 days before getting 2 greens yesterday and holding those 2 today. The Dow has had 3 reds, 2 of the past 3 days. You've had 3 reds. Again, 3 greens on the NASDAQ because of how bullish we were on the NASDAQ today, up almost a full percentage point, but not quite on the S&P because it hasn't been as bullish today. So not quite, not a whole lot of bearishness yet. The S&P again is above its 17-day moving average, even though the MACD is below its moving average, hence that convergence period. Where you're not going down, but you've also not really moving. You don't have that strong impulse move to the upside either. Remember, the Qs did do that. The Qs and MACD did get back above, but it's in convergence too. So don't expect like a higher high point to occur or a big histogram. Again, it's kind of like one of those last hurrahs that I just telling you about on the other chart. If we look at some of these other oscillators like the DMI. You remember it was a while where both of them were below 20, but then we did get up close to 30. We got a little bit above 30 on the day right before I left, but now we're back to where they're both below 25 again. Hence the ADX is falling, has fallen back down below 25 already. Hence you'll see pink shading or light green shading here is what happens when that ADX falls back below 25 there, and there you can see that's when you get the light green shading, but that's a good sign though, because you notice you don't really get pink shading immediately coming after the light green shading. It tends again kind of go in convergence mode. The bigger concern is when you go from dark green to dark pink. That happens quite a bit. When you look at some context here, when you get the dark pink shading. You can see, you went from dark, you weren't really dark green to light green for very long. You can see on a lot of these instances here. This might be one of the few periods where you got dark pink shading kind of coming out of nowhere. Usually you've had such a strong move and you're starting to give it back, and that leads to the dark pink shading kind of immediately. So that's a good sign for the market, suggesting that we probably won't get dark pink shading here either. If you look at the RSI and the CCI, again, they're at neutral levels. The RSI is still it's not above 60, but at least it's in the upper half of the chart. So that means we can move this all the way over to today. We're still green until we break 50 and then confirm it with a break below 40. You can break 50 and still stay green if it never gets below 40. Right, but once it does cross below 40, then you create that red box back where it did drop below 50. Right, both of these instances here, back where it dropped below 50. So we haven't had that cross below 50 yet. Obviously, we're nowhere near falling. On this chart, we have to get the weekly below minus 100, and that's not even an issue. So I can move this all the way to today as well, and you can kind of see that you're still very bullish. And no real main concerns yet. It's even with dips below minus 100 on the daily chart, even with dips below minus 200 here, you still never went off the dark green shading because of weekly chart. We weren't bearish enough to get the correction started, which is what happens when the weekly drops below minus 100. Let's take a look at the Ichimoku cloud. You can see we are still at mature bullish levels. So despite the fact that we've been kind of sideways and more neutral, at least we're still strongly bullish. We're still above the cloud. The rate of change is still positive. So everything is still very positive from that regard. Remember, IWM has not been as positive. It's been flirting with a negative rate of change. We're still above the cloud, but your green line is not, we're kind of below the blue and the green lines. We lost we had a weak bullish trend to begin with. We lost that trend. We haven't had a very strong, mature trend, brief one there. But, since all the way back to late last year, the Russell 2000 just has not been able to trend very well. Looking back over the last 5 years, really you can see, there's been just a few instances. Like I said, at the end of last year, there was a brief period in the summer of last year, but that's really kind of it over the last few years of these good mature bullish runs. Compare that to SPY, where we've had parabolic moves, right? Where we had a strong move there that summer, a strong move here at the end of last year going into the beginning of this year, and then another short-lived one here this summer. So the S&P can really get trending, and that's mainly because the NASDAQ 100, right? It's heavily influenced by the Magnificent Seven companies, whereas the Russell 2000 is not influenced by them. Let's take a look at the intraday range. As you can see, we haven't had a new high for a while. We haven't had a new low either, but that you can see that new low has really moved up. So there's today. This would be Wednesday, Thursday, Friday. So after this week, the new low is going to move up even more. So here is the range is already really low, extremely low. It's going to move up to an even more extreme low assuming we don't get a new high, right? If we do get a new high and it moves up as much as the new low will move up, then we'll stay here at this low level. But if we don't get a new high this week, the rest of this week, and the new low moves up to here, we're really going to be coiled. Especially if you can see we're already below 70. Obviously, in 3 more days, let's see, tomorrow, Thursday and Friday. So we'll go from 57 to 52 tomorrow. So we'll drop below 50 on Thursday, and then we'll be down to 42. So we'll be right here on, right about here on Friday. So going into Monday, when we would have that drop, we would be below 40. We'd be at 36.8 on Monday, assuming again no new high between now and then. And again, going into Tuesday, which would be significant. Now remember, we have jobs report, we have earnings, Microsoft earnings, we have a lot. Google earnings today, Microsoft earnings tomorrow. So we have a lot on the plate here that could potentially move the market outside of what is a very, very tight range. You saw that in the Bollinger. We didn't look at the Bollinger bandwidth. The Bollinger bandwidth is really low. We're not in the upper quartile anymore. The bands themselves are close to getting back inside the Keltner channels, which would mean red dots again. So we'll see, how that ends up playing out here. Looking at the looking at this 4-week range, and again, looking at this other chart that we use to visualize this range. We are below the average. So we are in bullish levels, and we didn't ever fall out of bullish levels. We stayed right there at 60 at the worst here, and we have bounced back up in the last few days. But we are still below the average, and we're not in the upper reversal zone, which is where you'd really want to be, because that's when you can maintain a trend, is when you're above the 80th percentile, and we're just not. So again, not necessarily the best sign here in terms of where we are trading currently. Where the close is, at least, in perspective of the 4-week range there. Looking at today's volume and ranges, it would not be surprising to know that we've been very low volumes, very low ranges for the last little bit. We're a little bit above average on the volumes, or at least right at the average, but that average is really down. You can see the average is dropping sharply there, sitting at 40 million shares for the 20-day average. Very, very low average. You can see we've been below 1%, which is the mark that signifies a new bullish trend. So that's a good sign. We haven't gotten too extreme, though I wouldn't be surprised if we did get even more extreme on this by the time we get to next Tuesday. So that's, next Tuesday could really be, and then next Wednesday, if we don't get a result on Tuesday night, those could be some very, very tight moves. Again, waiting on what would be the result to the biggest question mark that the market has right now. Market doesn't really care too much. As we all know, markets go up or down, no matter who the president is. But what the market does care about is the question marks, right? The market doesn't like uncertainty. They like certainty. So they like to get rid of question marks as much as possible. And so again, that's the biggest question mark right now that's been facing the markets for the last little bit. And we'll see how that plays out over the course of this next week. Let's go down to the volatility chart now. And the volatility, not surprisingly, the volatility remains elevated, right? We're not above 20, but we're close. We're not above 100%, but we're above 95%. We are not above 110, but we're close on the VVIX. And you can see, too, that we're not, that the VIX itself is not at above its short-term average lines. It's kind of sitting on them. But it is above these kind of longer-term average values. So, the volatility has been, it's not been rising. We've been in a pullback mode, but it's not dropping during this pullback mode. It's not surprisingly, right? That's kind of what you would expect, again, when you are anticipating the biggest question mark. Now, the nice thing is, I told you here before that the VIX doesn't drop until the skew drops first. Well, the nice thing is that the skew has dropped. Now, it hasn't dropped very much. It's still close to 150. 150 is extreme. It's been trading near 160. In fact, again, right after I left here, you can see right there on the 18th. So that Friday after I left, the skew closed that week at 165. Again, only the third time it's ever gotten above 165. So again, you can see like there was a lot of question marks, but since then, you can see in the week that followed and then so far this week, it's really dropped. Now, it's below its average, but the average has an extreme level. So, again, you have to really kind of, like, if the skew, what we really want to see from the skew is a drop back down, just for some perspective on where it should be trading at down here, right? This is where you want it to be, because this down in these levels is where it can start new runs. You can see where this big long-term run started after that correction, the post-2022 correction. The skew got all the way down below 115, and it started a great run. And skew rises when the S&P rises. Coming off the COVID, skew got down below 120. During post-2018, the skew got down below 115, 120, and started that great run there. Coming off the 2016 correction, it got down below 120. The skew did. In fact, the average got almost down to 120, and it started that great run there that ultimately peaked with the high skew. So you can see all these bullish moves before the corrections, peak with high skews. Like that, it was a high skew level there, and we had a correction. There's a high skew level here, even before that. The 15-16 correction, you can see here, the skew was at a high level there before that correction started. And then 2022, we had a high level of skew before that correction. Even 2020, it wasn't for very long, but we had a brief high level of skew there too, because that was a shorter time frame move between corrections before the COVID happened. And you can see before the stock market dropped, we had a high level of skew there. 2011, we had a high level of skew for the period before it dropped. So, and here we are again. Pretty darn high level skew relative to where we were. But every time that we started these post-correction moves, it started with a skew that had dropped down below 120, if not below 115. We did not drop below 120. We barely dropped below 150. That doesn't mean we can't drop below 150. Doesn't mean we can't keep going higher, as you saw in 2021. But it doesn't. But the problem is, it doesn't start a big long-term post-correction rally. It just basically extends the current correction rally that we've been on since 2022. So we're kind of extending a move without necessarily starting a new one. And what we really want is to start a new one, right? We want to get down here where we're starting at these lows. We want this kind of rally ahead of us, not behind us right now. And that's kind of what the skew is telling us. And that's kind of what I see going on with the skew right now. All right, the skew is, it's still relatively high and hasn't dropped down enough to really say, oh, we've had a pullback now. Even this intermediate pullback got down below 130. This intermediate pullback got down to, close to 130, got down to 130.8 on the bounce up. And so obviously we did not get below 130 this go around on this little mini pullback that we had while I was gone. All right, now let's talk about what's driving this price action here. Let's take a look at today's how things moved. Just on today alone, you can see over the last 3 months, gold still remains the strongest asset class by far over the past 3 months. Let's look at just today alone, and you can see it had a big gain today, along with the Q. So those are two asset classes that don't typically move hand in hand, but they obviously did today. Bonds were not up very much, but they were up against other asset classes, especially like international equities and international bonds and high yield bonds, for that matter. The dollar is relatively bullish too. Excuse me. Commodities and real estate really down. Real estate got hammered today, down full percentage point. Really, that's what's really hurting real estate more than just about anything is the climb in yields that we just continue to have. We've had TNX now up to, we hit 4.3% today before pulling back. We were at 4.34%. Again, very strong move up. It's been pretty much straight to the upside since the, what is it, right over here was the September 18th was the Fed cutting rates by 50 basis points. That was literally the day before is literally the day that the yield stopped going down and started to really move strongly to the upside. And it's been up almost every day since. A few days down, of course, including today, but not by very much. Very strong trend up to the upside. In fact, if you take a look at its DMI, right here. If you take a look at the DMI for the chart, which rarely gets up to such strong levels, obviously to the downside, it can really move up pretty strong. But you can see here we are on what may ultimately end up being a parabolic move to the upside. We've had these during the rate hike cycle in 2022 when rates were rising. All right, we had it at the end of 2023 when the first rate cut cycle was taken off the table. Ultimately, we started to cut rates over here in September, but the market was pricing them in late last year in Halloween last year. Has since come back, they were taken off the table and came back on here later. And here we are, with the rate hikes, rate hikes coming off the table again, and rates are moving up higher. Kind of interesting. I said before that the most bullish thing for the stock market for 2025 is that the Fed decides to only cut maybe one or two more times after that first cut of 50 basis points. Well, that appears to be the case. If you take a look at the rate cut odds for June, just a month ago, we had 92%, a little over 92% chance that we'd have 200 basis points of cuts by next year. Now it's only a 10% chance that we'll have those 200 basis points. If you go to the next week's meeting, still widely anticipated, and the bond market's already there too. You can see the bond market has been here since the last meeting. September 18th was the last meeting. Once it pulls up here, we'll be able to see it. So right here. So here's September 18th. We were at 4.7. A few days later, we got down to, basically the bond market pricing in this next rate cut here right around 4.625%. So it's almost there already, or it is there, and the futures market's there too. So the Fed's going to cut at the next meeting. That's not a surprise. Whether you think they should or not doesn't really matter. It's what the market really thinks it's going to do. And the Fed doesn't like to do things that the market doesn't think it's going to do. So, and here's the odds for that next cut in December is at 74%. But then in January, the odds of another cut coming in January, I'll give it a second to load up, it drops all the way below 50%. So right there already we're at a 50-50. So we're going to get another, we're going to get another cut, at least one more cut, and most likely a second cut in December. But then after that, it doesn't look like, again, it's a coin flip. for January, and it gets even worse, right, for March. When you look at this one's a 36% chance that we go cut all the way through March. So it really starts to drop off pretty significantly in terms of the odds of cuts. So you can kind of see that the market is now taking these cuts off the table. And that's creating some volatility in the markets, but ultimately will lead, as we saw in 2021 or 2023, it will lead to a good, strong, bullish market, and for that matter, also for most of 2024, before they finally cut here in September. The market's been bullish for most of this year, through the early part of the year, especially the early part of the year. A little pullback in March, and then through the summer, big time move in the S&P because the market wasn't pricing in cuts. Then we started to get the cuts, right? So we had some weakness at the very beginning of August, late July, August, and we did again in September, late August, early September. Just a little brief bout of weakness as the market started to price in those cuts, that first cut in September 18th. But now we can see we're kind of settling down a little bit of volatility, but for the most part settling down as these cuts come back off the table. The market doesn't like cuts. It's kind of a misconception the market wants rate cuts. The market wants low rates, right? The market wants low rates because borrowing costs are cheaper, the cost of money is, everything is good for the markets when rates are low. But the market doesn't like rates to fall. That's kind of like a conundrum, right? They want low rates, but they don't want to go to low rates. It's like saying that I like to go to New Zealand, but I hate flying to New Zealand because it's a 15 hour flight to get there. So even though I love it there when I get there, I actually don't like the trip that it takes to get to New Zealand for me, from where I'm at. So it's the same thing. The market loves low rates. It just doesn't like the path it takes to get to low rates. And so we've seen that. We've seen that over the last couple of years, and we're seeing that currently right now. And if we want 2025 to be a good year, we don't want low rate. We don't want that be on that path. We want to be on that path that we've seen right now where rates are rising. And ultimately, when rates start to rise again, we want to see this start to drop again, right? And so you can see it peaked right after the Fed cuts. It peaked, and that's great. We don't want this to keep going higher. We want it to stop going higher and to drop, right? That's the most bullish sign. And again, as we saw in 2023 and 2024, the market loves an inverted yield curve, and for that matter, late 2023. But the market loves an inverted yield, a falling yield curve, an inverted yield curve. The market loves that. It doesn't like the rising yield spread, especially when it gets back to a normalized level, right? All these instances here. This is the bear market, and this was a bear market, and this was a quasi-bear market. It was a recession, at least there. Again, kind of a quasi-fake bear market here. Remember, international stocks and small cap index didn't do so hot, and the large cap indexes did great because MAGA stocks ended up being a safety trade throughout 2019 and through COVID. So they don't like that path, and we never did really get up to high levels, up to that 200 basis points, and you can see the same pattern developing here on the spread between the 3 month, right? Yes, we're rising, but we're still negative here, and you can see that spread never got up to the high levels around 300 basis points. That's typical for it to get up to when it's on that typical path to the upside. That's typically coincidence. So the market loves it. It's up here because it can really start these big long-term moves to the upside. It loves this path right here, right? I love the drive through New Zealand. I love the drive through New Zealand. It was unbelievable. One of the best trips I've ever been on. So love the drive through New Zealand. I love getting to New Zealand. I don't love the path that it takes to get there, right? And that's kind of what the bond market is, and the stock market, for that matter, thinks about the yield spread. Take a look at the breadth. The breadth has been horrible since I left. We kind of peaked. The summation index, I told you that once you get above 1,000, the summation index the oscillator turns negative, and it has been the case. It's been negative every day this month except for one, right there, because we went negative at the end of September. We went above 1,000 at the end of September. So starting on October 1st, the oscillator went negative, and like I said, been negative the whole time except for a day. That's what happens. And we've been below minus 35. We just haven't really dropped, and that's a very, very good sign for the markets. And you can see we've really dropped here. So again, that sets us up for a convergence period like this that leads to a new bullish move instead of a consolidation pattern move to the downside. It leads to a new bullish move. Now it's not the best. It's generally going to be led higher by Mag 7 companies, as we saw today. But that's okay, right? It's okay. Like, you can see how bullish we were. I mean, ultimately it leads to a pullback, but we can. I mean, that was a couple of months worth of good bullish moves to the upside that we have the potential for post-election, because we are dropping so much. It allows us to get back up to 1,000, to have a pretty decent run, to be able to get back up to 1,000 before the breadth turns negative again. You can see the other signs of breadth that we like to look at. The new highs and new lows index is down. It's down, but it's not below zero. It's definitely not below minus 100, but it's below its average. The average is falling. Number of stocks at new highs are way down, right? So that's not necessarily the best sign. The average is really falling too. So that's not the greatest sign there. The number of new lows is actually starting to rise. The highest level it's been since the pullback, right, at 44. Still not at the 72. That's kind of where you start to worry about the Hindenburg omens like we had over here. We had 5 of them over here, 5 straight in a day. So we're not to those levels yet. And we're definitely not to the 4% mark, which is where this 117 is. That's your 4% mark that either can start corrections or end pullbacks, right? You can kind of get the idea there. This is another sign. Again, this has been a pretty sharp move up above 1 and above the average. That's typically not the most bullish. But again, the fact that it's moved up so much and we haven't dropped sets us up for that kind of move like we had over here, where over here we actually ended up going up to 125 and then we fell, right, and able to keep going higher. It gave us some room to go down without falling below 1 until the very end. So now we have some room for it to fall, which is bullish, before it falls below 1, right, which sets us up for a peak there. So that's actually a good sign, even though the breadth has been. So the fact that the market's been so bullish, here's the bullish percent index falling below 70, but not quite below its average yet. So we're still okay. So the good sign that the markets have been able to stay flat while breadth has been horrible sets us up for a new strong breadth move to the upside, or even kind of a lackluster breadth move to the upside if the Mag 7 outperforms and we're okay, right? And we're kind of set up for that. The Qs, have been flirting with breaking above this 2.25 level and trending up to the upside. And it looks like we're kind of moving in that direction. The long-term PPO is rolling slowly up to the upside. So it looks like we're getting to that mode where we can get a good run on the Qs to lead us up to to a lackluster breadth move. But as long as the Mag 7 stocks outperform post earnings and post election, then we can get a good move into the end of the year, get that good strong seasonal move that the market typically gets going into the end of the year. If you take a look at the sector rotation, that's kind of what we're seeing, right? We're not getting a strong move higher into technology or rotation in technology yet. It's still down here in the yellow, but it is one of only 3 sectors that are on this side of 100. And it is above, its moving averages up here, and you can see the relative strength is above its 50-day moving average, and both these lines are turning higher. So that is a very good sign to have XOK outperforming the S&P 500, close to getting back above the 200-day. So a good strong break above that 200-day. Again, most likely would coincide with lackluster. Doesn't have to be negative, but kind of very weak and lackluster breadth. But that's what makes the markets bullish. You can see it's positively correlated with the markets. So the more it outperforms, the better it is for all of us. Again, heading into what is seasonally a bullish time of year for the stock market, right? Into this end of the year. If I were to go to SPX here, into that end of the year run, we're really, kind of the end of October, we really start to take off going into those last 2 months of the year. All right, now let's take a look at our trade idea of the day. We'll take a look at Microsoft heading into its earnings announcement, setting up with a good bullish pattern, getting a bear tag, which again usually leads to the beginning of intermediate runs, right? These these bullish intermediate runs typically start with these bear tags. All of its lines are moving higher, even if they're not necessarily at bullish levels. Really, only right now the near-term lines at bullish levels, but the intermediate lines, at least in the upper half of the chart, hence the green shading. And we'll see if that once that line starts to turn higher, once we get a little bit higher up above the moving average, then it will start to move up too. And then you'll have dark green shading in the green line. Depends upon that earnings announcement, right? The momentum line, which was extremely low yesterday, rebounded today, got back up almost to the near-term line. The intermediate line has already crossed with all the lines in between the reversal zones, these crossovers matter now. So the intermediate line crossed above the market sentiment line, that's bullish. The near-term line today crossed back above the intermediate line, which is bullish. So both good signs heading into a good, potential, and you can see it's actually up a little bit today in the after hours. A good move which is why we do the Market Outlook Live before the market closes. We can ideally take advantage of that. When you look at the long-term chart, you can see excuse me, that we got a new bullish candle here for the week. We're not up. It's not a higher close. At least it's not higher than the transition week's high yet. But again, we'll see. The week's not over with. We're only 2 days into the week so far. If you look at the 3 green arrows, obviously we have 3 green arrows right now. Have had 3 green arrows here for a while. It's a good sign for the stock. Ideally, again, we got to get that moving average to turn green again so that we can be able to get it going higher as well. You are above all these moving averages, hence the 3 green arrows. But you also notice the 8 and 17 day are crossing above the 30, which is a good sign, right? It's a good crossover sign when they both cross above 30. So that's happening as we're getting up to the top of this big volume node, top of the value area, working into an area with very little volume resistance. That's a good opportunity. If you take a look at some of these other oscillators, looking at the DMI, you can see it's set up with a bullish pattern. It's above 25 on the positive, below 20 on the negative. So the ADX is rising from a very low level. It got down to a very, very low level down there. The RSI and the CCI had also, not necessarily today, but has already crossed into bullish levels as well, both the RSI here and the CCI down there. If you look at the Ichimoku cloud, you'll see that we're above the cloud. The rate of change is almost positive, and you can see it's kind of working towards crossing through and being positive. We don't even have the beginning of a trend started yet, so there's an opportunity for that to be the case. And then you look at the Bollinger Bands and the Keltner channel, and you notice we are flirting. We at least are in close to the upper band. The bandwidth is really low. Obviously, you're above it now in the after hours, and you're flirting with that upper Keltner channel now in the after hours as well. So really good pattern. So going into this earnings, that's not today, it's tomorrow. But going into that earnings, I decided, okay, well, let's go ahead and take a look at selling the 455. It's actually the delta was in the low 20s when I first got into it. Now it's obviously moved higher, as you can see. The stock is trading right now at the 436 level. Obviously, we did not get into it here at 441. It was more at 431 where we got into it. Actually, no, excuse me. It was more at 431 is where the close is. So it's closer to that level. So that will reflect after the market opens tomorrow. It will reflect that change. So we've got, we already had, it's a relatively high probability trade because of the earnings. It's a pretty high probability trade. We kept the risk pretty low like we always do with our position sizing. So we have an opportunity to really kind of get a pretty decent return at a relatively high probability, especially kind of, again, considering the start that we may be having before we even get to its own. I think this is mainly based off of Google's earnings before we even get to its own earnings announcement. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.